PA. I'm not an attorney. It's been close to 30 years ago. I got sued. I was running a recreation park down in Southern California. Miniature golf, batting cages, and water slides, and that kind of stuff. There was a drive-by shooting. Um, we ticked off a couple of boys. We'd kicked them out of the arcade because they were beaten up on a video game. 10 minutes later, they drove by, rolled the window down, fired 3 shots into a parking lot. Darla was 18 years old. It was her birthday that day. She had her 2 best friends in the back seat. She opened the car door, stood up, took a bullet to the head, and I got sued because I was the manager on duty at the time and should have reached out and stopped that bullet. And my life turned upside down for 3 years. It was hell. I didn't know if I could buy a car. I didn't know if I could move. I didn't know. It was the most devastating thing of my life. And not just to see her and to see the outcome, but what it did, the impact it had on our family was so I am absolutely passionate about asset protection. I'm passionate about helping students um, be confident, know the rules, they know the rules of the game so that they can play the game. I've written since then. I've written 5 textbooks on lawsuit protection. The latest one is this. There's over 400 references to what we do. This is like the asset protection Bible used throughout the nation on how to protect specific assets. I've run a hotline for 24 years. People call in, ask tax and legal questions. This is what I do. I've been a vice president of legal and compliance of some major corporations, managed up to 40 different employee or attorneys. I'm not an attorney, but I understand the lawsuit game very well. So that's my background. We also run the longest running asset protection class anywhere in the nation. It's called the 3-day Asset Protection Summit. Give us 3 days. The theme of our class is a lifetime to accumulate, 3 days to protect. We're very good about systematically going through and teaching you what you need to know, what you need to do to protect your assets. So that's a little of our background. When we speak, we're bringing some of the best of the best of the best instructors. Um, Former senior trial attorney from the IRS who's turned around and sued the IRS over 2,000 times and doesn't lose cases. Bill Danko, co-author of The Millionaire Next Door, not a better expert in the nation. The best people that we can bring to the stage. This is who we're bringing, and I've been surrounded by, for the last 25 years, some of the best attorneys in the nation. I've been very blessed, and so in just a few minutes, let me give you an overcap of what we do. We call them America's defensive coordinators. Some of the people we've worked with over the years. Okay, before we talk tax and legal, there's always a disclaimer. I'm going to throw out a lot of ideas. Not everyone will apply to you and your situation. Maybe you live in a different state. Maybe you have kids. Maybe you don't. Maybe you've got a C corp instead of an S corp. Or I don't know. Whatever. I'm going to throw out some ideas and then encourage you to either come to us and get more information about it, or before you implement anything, always deal with a professional. All right, so here we go. If I were to look at an investor, here's what I consider to be the major and threats that you have. I categorize them in 4 different ways. I call them the 4 financial tornadoes. If you've ever been through a tornado, you know that they can be random. They can hit your house, jump over 14 houses, hit the school, hit the bank, and go away. They can be random, but when they hit, they're almost always devastating. And they're in no specific order. I'm going to try to touch on a little bit. I know John's going to be a little bit later, and so I'm going to hit taxes lightly and spend a little bit more time on lawsuit protection than I can, if I can. Okay, but let's hit taxes and give you just a couple little simple ideas. Investors somehow get away thinking that they're winning the tax game if they're getting a tax refund. Throw that out of your mind. It has nothing to do. If you're getting a refund, it means you paid too much along the way. That's all it means. You need to start tracking your effective tax rate. What is that? Well, you take the taxes you paid divided by the income that you made. That's your effective tax rate. And if your effective tax rate is in the 30s and 40%, you're paying too much. Once we can get it down into the teens or lower than that, let me show you an example. LeBron James, a few years ago, reported that he had an income of $124 million and he paid 43 million in taxes. His effective tax rate is therefore 34.9%. He didn't have a business. He's a W-2 employee. Here's the difference. Look at some of the wealthiest people in America and what they make and what their effective tax rate is. Look at this. And if you're paying 35% in taxes, it's going to be eating you alive. But be looking at your effective tax rate, not whether I got a refund back or not. Know that there are free roads in the tax system, just like there are toll roads, but there's no blinky signs on the freeways. They only advertise the things that they want you to do. So let's kind of break this down. The number one thing I think investors can do, and in my experience, is you're not saving enough for retirement. And not just about saving, it's about using tax-free environments. Right now, yes, you look at this and you go, well, I could be putting $7,000 a year. That's not enough for me to worry about. But business owners could be putting into $69,000 and even up to $270,000, depending on the first four are called contribution plans. Defined because the IRS defines the contribution, but then there's also what's called the defined or oh, I can't think of the word for heaven's sakes. Just got back from Cancun. We did a corporate retreat down there, and I've been a little suffering from Montezuma's revenge, and my brain's not working as effectively this morning as I want to. But here we go. Defined contribution plans and defined benefit plans. This one allows. I helped a lady just last year put in $300,000 expense from her company and put $300,000 into her defined benefit plan. Expense from the company, tax-free to her. Are you kidding me? Until she starts pulling money out of retirement. There are free roads and there are toll roads. And the only one that they really tell you about is, oh, you can put up $7,000 this year. Woo woo. That's not much for a retirement plan. But your SEPs and simples and other things, they're really good tax advantage plans. The second thing I really want you to know, and I really think it's a strong advantage for investors, is understanding real estate losses. And the more I talk to students, the more I realize how little we understand that. You hear the word loss, you go, I don't want to lose money in real estate. Let me explain it the very best way I know how to explain it. Let's take a piece of real estate you're going to buy for $600,000. This is a turnkey property. It's all ready to run. Here's my tax impact this year. Is if the land I can't depreciate. The land is an investment. It is what it is. But the building on the land, that I can depreciate. If it's a residential property, I get to divide that, the 450, what's in white, by 27.5, showing a loss in real estate of $16,000. Now, did you lose money in real estate? No, you didn't lose money. You invested $600,000. Does it matter whether it was mortgaged or whether I paid cash? It does not matter. Depreciation is irrelevant to whether I paid cash or not. So I get a $16,000 loss. That goes to wipe out any other investment income that I have. Stock market, real estate, doesn't matter. I can wipe that out, and up to $3,000 of W-2 income. If I can't use all of that loss this year, I can roll that forward to next year. Now, is anybody couldn't use a $16,000 loss in real estate? Oh, well, yeah, that'd be a great thing to have, right? But it gets better. Let's say that the property was not turnkey. This is going to be a fixer-upper. I'm still going to spend $600,000, but the accountant's going to split it up a little differently. I'm going to take the land. I still can't depreciate the land, but but the accountant's going to want me to separate improvements from repairs. And there's some technical differences between them. Basically, replacing the carpet, replacing the roof is a repair, but if I upgrade and call it an improvement, I add on a bathroom, I go from asphalt shingles to tiles and I don't know, whatever. Those are called improvements. Here's your tax impact if we split this up a little bit differently. And it says 2022, but just same thing applies to 24. My depreciation expense, I'm going to take what's in white, the 200 and the 100, divide that by 27 and a half years. It shows me a tax of my tax impact or my loss in real estate of $10,000. Well, I like the $16,000 better, but what happened to the repairs? As long as I can put this in service by the end of the year, I get to count 100% of the repairs right now this year, showing a $160,000 loss in real estate. Whoa, baby. Oh, against all other income, investment income that I have, and up to $3,000 of W-2 income. If I don't use it all this year, I get to roll it forward. Are you kidding me? $160,000 real loss. That's good. This is how Donald Trump says, I don't owe any taxes this year because I had so many losses rolling forward from previous years. But it gets better. Watch this. What if we added in cost segregation to this, and we took the 5-year assets, which would be, things that are going to depreciate in 5 years, the carpets and some of the lighting, and I take that and accelerate that and count that all this year, and then I take and with 2024, and the Congress is still debating, but it looks like it's going to run through that all of that bonus depreciation from 22 comes forward to 24. I also then get to count all the 15-year assets. So we come in and we put a price tag on every tree, every shrub, your parking lots, your painting on the outside. We look at everything out there. We add all that together, and here's how it breaks down. Watch this. I'm still going to spend $600,000. I can finance it or not. I can't depreciate the land, but look how it breaks down. Still adds up to $600,000. But here's how it breaks down. I take what's in white, the 125, the 25, divide that by 27 and a half years. My loss in real estate is $5,400. But I also get to count the repairs that I put in this year, and I get to count in the cost segregation plus bonus depreciation. Now you have a $305,000 loss. Are you kidding me? Did you lose money in real estate? No, but on paper it shows that you did. And this is how the wealthy. So you've got somebody that makes $1 million in the stock market, doesn't want to pay taxes. So what do? We offset it with real estate losses. We buy one property, buy as many as you want. I don't care. The numbers work regardless of how big or how small it is. I just used a $600,000 project just to show you the difference. Are you kidding? Real estate losses are the best way for investors to wipe out income and not pay taxes on it and roll that forward. A lot of you are missing another expense that's a really big one, and that is as long as you have a business, and I don't care whether it's a sole proprietorship, partnership, S Corp, C Corp, I can deduct insurance premiums. But if I've got somewhere in my mix a C corporation or an LLC taxed as a C corporation, then I can now deduct my family's medical expenses, co-payments, prescriptions, herbs, supplements, anything that was prescribed. dentistry, vision, for my kids, for my orthodontist. So all of that stuff. If I've got a C corporation, and inside of that C corporation, I've got in the corporate bylaws, whether it's bylaws, it's somewhere in the corporate documents. Maybe it could be a resolution. Maybe it could be the bylaws, the initial meeting, somewhere in your corporate documents. You've got a Section 105 medical reimbursement plan. Now, all of those things are deductible. Now, I can't discriminate. You got to play by the rules. But if my wife and I are the only ones that have this corporation, maybe I've got other businesses, but it's funneling money to my corporation. I'm not discriminating because we're the only employees. It's my wife and I, and now all of these things become tax deductible. Learn the rules, play by the rules, but wow, a powerful tool. Some of you, maybe a C corporation doesn't make sense, but at least take advantage, if you can, of a health savings account. This year, you could be putting in my family, because my wife and I are over 50, we'd be putting in $8,750 in addition to my IRA. And here's the dirty little truth that they're not telling you is I could take this and I could self-direct it. Wait, I could take this plan and self-direct it, and it partners on a real estate deal. It could buy crypto, it could buy real estate, tax liens, tax deeds, whatever. I could be using this money and not relying on the current custodian that's giving me 0.5% interest. Oh, baby. Yeah. Children, great tax advantage. And you'll find that whenever I find wealthy people out there, always taking advantage of the children's, exploiting maybe a strong word, but they're taking advantage of the children's non-existent tax brackets. Children can make up to $14,600 this year without them paying a dime in federal income taxes, or most cases state income taxes. And if you do it right, even self-employment taxes. What could you pay them for? Well, you could pay them for accounting, bookkeeping. So your 6-year-old might be better at social media than you are. I don't know. Website development, resident morale. Let's say you've got a residential assisted living home, and the 3-year-old comes in, sits on grandma's lap, and better at cheering up grandma than you are. There's so many things. Modeling. That Gerber baby made some money, I would assume. Take a picture of your kids, put them on your website, do something. Now, there's a difference between earned income and passive income. And so I've given you a difference, and the lines are different, but the money for it to be 14,600 has to be earned income. But find a way, compensation has to be reasonable, but find a way to start paying your kids or your grandkids out of your business. What could they use the money for? Well, first thing I would do is I would contribute to a Roth for them. A Roth is a triple tax-free environment. For the kids, let's say you put $6,000 in a year while they're young. They could use that money for, they could use it for college. They could use it for a first-time home buyer, emergency medical. If not, you grow that and invest that. Several years ago, we had a little 8-year-old. We set her up on our stage. We said, Maggie, what's in your Roth IRA? She's 8 years old. She's in second grade. She says, well, I've got 2 residential rental properties, and we got a commercial property. And her mom whispers in her ear, yeah, you got some business loan startups. No, Mom, I've got 2 business startups. So she's promissory notes to businesses. And this little gal, can you imagine sitting around the table in second grade with your little milk bottle and discussing what your investments, what's in your Roth IRA? Wealthy people are using these tax advantage systems all the time, and it's a great way to save money. And a lot of you at this point, maybe you're thinking, well, my gosh, I've got a really stupid account. No, you don't. It's you're giving them the wrong information. Again, John's going to talk about this a little bit. But look at, ladies, if you have a purse, look at your purse. Our purse is tax deductible? Of course not. My wife doesn't own a single purse. I tell you. But cell phone cases for your business are tax deductible. Computer bags are tax deductible. Tablet cases are tax deductible. She has a whole cabinet, I mean, a whole closet filled with computer bags. She doesn't own a purse. Computer bags aren't taxed, or purses aren't tax deductible. Look at this vacation. Is it a vacation or is it a business trip? Is that a big screen monitor for your computer, for your office, or is it to watch the Super Bowl this Sunday? Why did you spend money on a big screen TV? Is your dogs aren't tax deductible unless, oh, maybe it's a guard dog for your business. That, like, don't be I throw these things out, the tablets, the computers, the vehicles, all of these things can be tax deductible. Remember to be reasonable, customary, ordinary, um, for your type of business. But all of these things, according to the IRS code, can be tax deductible if your business is structured correctly for that expense. So entertainment, not tax deductible. You all know that. However, team building activities, holiday parties, annual picnics, summer outings, those are tax deductible. Um, Corporate retreats. This is a picture down in Cancun I took on Wednesday morning from my balcony, right outside my room. We had a little walkout pool or swim up pool or whatever you called it. Tax deductible corporate retreats. Learn the rules and play by the rules. And we didn't take a vacation. This was a business for the business owners. Meals, 50%, you all know that. Unless, however, it's catered, it's team building, holiday party. Know the rules, because sometimes it can be tax deductible. I'm always amazed at the business owners that come that don't take advantage of a home office deduction or don't keep a mileage log. It's 67 cents a mile right now for this year. Take advantage of these things. And you go, well, I don't want to nickel and dime the IRS. Are you kidding? That's how you win the tax game, is sometimes nickel and diming the IRS, and you'd be amazed at how fast that 67-cent per mile adds up if you're taking advantage of it. I find business owners all the time that aren't deducting their cell phone because the IRS right there in the code says, you got to keep track of personal versus business, but then there's an IRS ruling that interprets the code and says right there, 2011, a business can provide a cell phone for an employee that's also a business owner without the requirement for record keeping. If your business requires you to have a cell phone, you can deduct it. So look at it this way. And this is my last slide on taxes, and then we'll move on. Any corporate deduction that big businesses can take, small businesses can take if you're structured correctly. Maybe you have to be a C corp to take advantage of this. Maybe you have to be a sole proprietorship. Maybe a lot of things. But learn the tax code enough that and be asking your accountant really good questions. It's not about having a better CPA. Sometimes you need to give them the correct information in the right way. This was not a purse. This was a cell phone case. This was I don't know, whatever. Just we're going to cover a lot more tax strategies when you get to our 3-day asset protection summit. I'll tell you about that a little bit. And in fact, I would say probably a third of our 3-day summit. Every speaker brings in taxes because it's critical that you understand that as an investor. All right, I'll tell you a little bit about that later. Let's talk about probate and estate taxes. Probate and estate taxes, after you've paid your taxes all your life, probate, these are two optional taxes. And I say optional because you can avoid them. Jackie Kennedy died with a $100 million estate. I don't remember the numbers. You know what she paid in probate? Zero. You know what she paid in estate taxes? Zero. We can take almost anybody's estate if if it's not a deathbed creation. If you give us the tool, use the proper tools in a timely manner, we can avoid probate. Probate is the process of figuring out who gets your stuff because you didn't have a written plan for it. And a will is going to put you directly into probate because a last will and testament is directions to the probate court. And so everything's going to be tied up in probate for um, months, years, decades. My wife's family's estate. Well, let me show you this. This is my wife's family's little estate. It's Mohawk Mountain Resort up in the Catskill Mountains in upstate New York. It's up by Poughkeepsie, New Paltz, that area. This was part of their overall estate. They were also the founding fathers of Redlands, California. Estate planning was done on the New York side, but not on the California side. California, they had huge orchards. They brought in citrus. They had the largest botanical gardens west of the Mississippi. You had the director of Indian Affairs was one of these brothers. Two presidents of the United States visited their estate. I mean, it was a massive estate that owned a big part of the San Bernardino Valley, all the upper land that now all the multi-million-dollar homes are built on. They owned all that. But no estate planning was done on the California side. There were 5 heirs to it. My wife remembers her great grandma. And I think we have 2 antiques from that estate. Everything else was gone because it went through 19 and a half years of probate. Estate taxes and trustee fees and attorney fees and when everything was all settled, each one of the 5 heirs received a little over $5,000 and the estate was gone. And my wife, although she remembers her grandma, there's nothing left of the estate. I hate probate. My wife's parents were divorced. She grew up living on food stamps when there was money. It was a horrible experience. This multi-billion-dollar state didn't have to end that way, and yet it did. I hate probate and I hate estate taxes. So most of you understand that the best way to avoid that is to have a revocable living trust. I call it your big Tupperware bowl. All of you understand this concept because most of you have a big popcorn Tupperware bowl, but you never put it in the cabinet empty. You always put all the little Tupperware bowls inside of it, put the lid on, shove it away. That's okay. That's your revocable living trust. Most of you understand that your home, probably to avoid probate, ought to be retitled in the name of the trust. If you've got bank accounts, brokerage accounts, they ought to go in the name of the trust. If you've got rental properties, they ought to go in the name of a trust. These things will avoid probate. Vehicles can avoid probate. Where a lot of you don't understand is that I could take an IRA and maybe I'd set up the IRA for my benefit when I retire. I listed my wife as the contingent beneficiary, but then I listed the trust as the second contingent. In case she's not around, I'm not around, then it goes into the trust. Therefore, the trust is where you're going to establish your values. We value education, my wife and I. And so if you'd like money out of the trust for education, there it is. But here's the parameters. You had to have a 3.2 grade point average. You can't be a druggie. You can't. Here we left money in there for military service and community service. And we here's what we value, and here's how to get money out of the estate. We could also take your insurance policies, and a lot of you aren't doing this. You have a trust. You've got an insurance policy, but what happens if your spouse? I listed my wife as the beneficiary, but I listed the trust as the contingent beneficiary. Okay, so most of you sort of understand that on a big picture. Here's where I'm seeing business owners not understanding a concept. And that is we always tie all of your business entities, whether it's a C Corp, S Corp, LLC, what family limited partnerships, we always tie those down as well. I helped a little lady a couple of years ago. I was in Indianapolis. I met with her. They had a water drilling company down in Texas. Husband dies in a rodeo accident. Um, and now she's left as a widow, 38 years old, with four little kids. Oh my gosh, what do we do with the business? Oh wait, they didn't own the business. He owned the business. It was a single member LLC. Who owns it now? Well, it's going to go through Texas probate. And it may not be worth $4 million, the same as it went in before, after Texas probate of 9 months figuring out who owns it, even though it's clearly it's going to be her, but she can't run the company right now. Are you kidding? We always take, if you've got rental properties, if you've got a business, we take your interests of these business and tie them down to a succession plan, or they will go through probate. We don't want to do that. We don't want your businesses to go through some kind of limbo that's going to tie them up for decades, or I don't know, years, even months. We want your business to be seamless. If I pass away, then the ownership is very clear. We're going to spend a lot of time at that at the 3 day summit. In fact, I'm going to spend probably 3 hours at the end teaching case studies. Remember, Scott talked about this. Remember, Clint talked about this. Mike talked about this. And this is how it all ties together. And here's how we fund that trust so that it avoids probate. You're saving all the money you can on taxes. You've got really good asset protection, isolation of each activity from each other, and it ties into a trust. We're going to teach you that when we get to the summit. Okay, tornado number 3, capital gains. Most of you understand if I'm going to buy and sell something, there's a tax, and it's usually a reduced tax from ordinary income. And in fact, if it's a short-term game, meaning a year or less of that I've owned this product, and maybe it's a stock, maybe it's a piece of real estate, maybe I'm flipping houses, maybe I'm buying and selling cars, whatever that is, if it's less than a year, I'm going to be paying ordinary income taxes. But long term, I mean, I've owned the property for a year or more, a year and a day, or I've owned the stock or the crypto or whatever. Well, that's good. And if I had time, I would show you the impact of paying capital gains along the way. Some of you go, well, it's only 15, 20%. I don't like paying it. At the summit, we're going to teach you at least 10 different ways. Shows 9, there we go. 10 different ways to avoid paying capital gains taxes. Because as you buy and sell in your life, if you're paying those taxes, it will absolutely eat you alive as an investor. If you can buy and sell in tax-free environments, the number one way is using qualified retirement accounts. If I'm not paying taxes along the way, it's going to grow much faster than if I am paying taxes. Then there's not a lot for you to protect. I'm not going to spend any more time on that. I'll give John Hyre the opportunity to teach about capital gains, or come to the summit where we're going to teach you that. Let me give you the opportunity at this point, if you'd like to sign up for our 3-day asset protection summit, and then we're going to talk about asset protection and how to protect and isolate assets. There's 2 opportunities for you to attend. One is in March. It's in actually 3 weeks from now, March 4th, 5th, 6th. The other one is in April, right after taxes are due. So March 4th, 5th, 6th, if you would like to sign up for that class, this is a class that used to be $3,000 to attend. Once we can do it on Zoom, and it doesn't matter whether we have 100 people sitting in a ballroom or whether there's 600 on there call, it doesn't matter to add additional people. So we can now offer this $3,000 class to single people for free. So you're welcome to attend it. The only thing that we ask is that you attend all 3 days. Don't come in and learn half a tax strategy, half of a legal strategy, and then you become dangerous. Learn the strategies that we're going to teach. Remember the theme of our class: a lifetime to accumulate, 3 days to protect. Give us 3 days, and we're very, very good at teaching in a systematic way how to protect your assets. Okay, so let's go on. And here's what you're going to see when you go to that website. We're going to ask for very limited information, and then you'd be signed up. So there you go. Let's talk about lawsuit protection. Okay, especially for real estate investors. Let's say you have a rental property. You're going to get the dumbest advice on how to run things. People are going to tell you the oddest things. Even your accountants, even your attorneys are going to tell you stupid things. And so let me cut through all these things and let me be as clear as I can be. The biggest advice that people give you, which in my mind is just carry more insurance. Are you kidding? Look at some of the things that insurance will not cover. It's not going to cover mold and mildew. It's not going to cover lead-based paint. It's not going to cover chemical spills. Somebody tips over a 55-gallon barrel of oil in your backyard. You're going to clean it up. And there's no insurance company that's going to come in and save you on that one. Rental vacation or rentals. So if you're flipping a property, your renter moved out, and now you've got some rehab to do, and it takes more than 30 days, and somebody comes in and steals your air conditioner. I learned this one the hard way, off the back porch. Insurance isn't going to cover it because it's been vacant more than 30 days. And we learned that one the hard way. Wrongful evictions, discrimination. Look at the things that insurance will not cover. And that's why I want you to have good insurance. Let me be clear. I do. I want that to be the first line of defense in the event that something happens. But most policies are not going to cover these things and a whole bunch more. Read your policy and it'll scare you to death of what the insurance company disclaims. Insurance companies make a lot of money collecting premiums and denying claims, and the very best attorneys in the nation are not going to be defending you. They're going to be defending the insurance companies for a reason. So look at that. But I still want you to have good insurance, but don't use it as your number one. You always use legal structures at the end of this. So insurance first, and then we still use LLCs with limited partnerships, corporations, to separate this activity from this one. Land trusts, number two, it provides great asset protection. No, land trusts are really good smokescreen, unless your property's in Florida, which this would be an exception. It's not going to provide asset protection. It's going to provide a smokescreen. But in a deposition, I sit down and ask you, if you own the beneficial interest of this land trust, I'm going to take the property away from you because it's not good asset protection. It's a smokescreen. That's all it is. And I love land trusts, but you use them for the wrong reason. And I'll tell you that 90% of the students that I see that set up their own land trusts screw it up, and you don't. I could give you so many examples. Land trusts are great smokescreen. They are not asset protection. And let's say I've got a rental property and you go in and do your own, saving money. So I do the own roof repairs. I do the own electrical. I do my own plumbing. I saved myself a ton of money until there's a lawsuit. And now they're not only going to sue the homeowner, which is your LLC, but I'm going to sue the person who did the repairs. Oh, wait, that's you personally. And they're going to come after you. So if you're owning rental properties, always pay a little extra, but don't be doing your own repairs on your own. Failing to fund your LLC. Funding is the process of putting stuff in. So I see people all the time that have their LLC set up, but the property is still in their name. Well, yeah, we had to put it in our name to get financing. Are you kidding? If you don't know how to get around that, you need to come to us and let us teach you how to put properties in and avoid the due on sale clauses of your mortgage. But failing to fund it, the LLC can only protect it if you put the property into it. It doesn't work if the property is still in your name. I've seen a lot of our students that hold their properties in one LLC. In fact, Probably 2 weeks ago, I had a student own 23 rental properties in Florida, all in one LLC. I go, well, okay, is that a big part of your overall wealth or is that a drop in the bucket? Oh, that's everything I own is right there in that one. If one property gets in trouble, do you know that everything inside that legal bubble is at risk? We wouldn't ever do that. We would isolate those. I see people holding properties in their living trust. A living trust is a probate tool, but because it's revocable, it's amendable. I can change things. I would always put things in an entity first, which is then tied to your revocable living trust, but don't put it in a revocable trust all by itself because a trust is a probate tool, not an asset protection tool. I see people putting in properties into a C corporation. Are you kidding me? Then you lose all the depreciation deductions. You lose the pat. Remember we talked about losses. That you lose that. They're all locked in the C corporation. All the tax benefits of owning real estate are locked in that. Or sometimes I see people putting all their properties in an S corporation or flowing through to an S corporation. Yes, that's a passive thing. That's good. It passes through to me. The problem with the S corporation is if you die, the kids do not get a step up in basis. They will end up paying all the capital gains taxes. That's a revenue ruling that came out last year, revenue ruling number 2 from 2023. We don't hold properties in an S corporation. Single member LLCs in most states do not provide charging order protection. So I've got properties, yeah, each property is in its own LLC, but you're the owner of the LLC. You're the member. It's a single member, all tied to B. If I sue you personally, I'll come in and take all of your properties away because it's considered in most states to be an alter ego of you. There's no charging order protection. And so we use the right states, we use the right legal structures. If whatever investments you have, whether it's stock or whether you're using syndications, what we always hold those, separate the activities from each other, but we hold those in the right legal structures. Let me show you. We're using an out-of-state entity as well. So I'm trying to protect my Indiana LLC using a Nevada corporation. Why, if damage is done in Indiana, why would they have to respect the laws and jurisdictions of Nevada? If the damage is done here, the property's here, I'll just take the property away from you. They using the right entity, the right tax formation, using the right state is imperative. We're teaching you how to do that. Let me tell you the very most frequently asked question I get in customer service. People call and say, okay, I've got a rental property. I've got real estate. What's the best legal structure for me? And my answer, and I'm not being flippant, my answer is it depends. And I'm not being flippant I'll tell you what it depends upon. And here's what I look at. Are you flipping or you're holding the property? Do you own the title or the note? Are you using a qualified retirement fund like an IRA to hold the property? If not, that would affect how I'm going to hold it. Are you using leverage? Are you using other people's money? Are you financing it or not? Are you using syndicated funds or are you buying a syndication? All of these things matter. Where you live, what state you live in, and all of the investors U.S. citizens? And all of these things have an impact on the legal structure that I might suggest for you, as any qualified attorney, any qualified professional would do. They're going to ask you the right questions. Those are, in my mind, some of the most significant questions. Let's just break down the very first one because it's the easiest one for me to explain. Are you going to flip or hold property? So if you're going to hold the property, here's your concerns. You're worried about resident safety and property managers. I'm worried about maintenance. I'm worried about protecting my equity. I'm worried about simplifying paperwork. If I have 6 different properties, do I need 6 LLCs? Do I need 6 different bank accounts? Do I need, oh my gosh, this becomes really complicated now. How do I simplify this? Depreciation, I don't want to put it into a legal structure where I lose depreciation deductions like a C Corp or passive losses like a family limited partnership. I don't want to do those things. If I'm flipping properties, though, my concerns are very, very different. I'm worried about construction liability. I'm worried about subcontractors not getting paid. Buy sell contracts. I'm worried about capital gains. I don't want to. I don't want to be paying capital gains on short-term rentals. I'm worried about dealer status. If I'm flipping over here and holding over here and I'm using the same entities, all of a sudden I get labeled as a dealer in real estate. Are you kidding? That label is by the IRS and it's going to stick for 3 years. I'm going to lose depreciation deductions on all of my properties for 3 years. I'm going to lose the ability to do a 1031 exchange. All losses are going to be subject to self-employment taxes of 15.3%. I can't do an installment sale, which means if I sell a property and I'm going to get paid over the next 7 years, the IRS wants me to pay the taxes right now this year, even though I don't have the money. Are you kidding? Dealer status is the worst thing that can happen. And if you've got the wrong legal structure and you're flipping and holding at the same time, you get hit with dealer status, and it's going to cost you more than that flip ever made you in profits. We learn the strategies that are going to benefit us, but also protect us. But since the concerns are different, do you understand that what we would advise, the strategies to protect you are going to be very, very different. If you go to your accountant and say, okay, I've got a rental property, and he goes, well, you'd certainly use an LLC. Are you kidding me? And if they're not asking you the right questions, they're going to give you really lousy advice. We have to know that what you're doing. Okay, let's take a second and let's tie everything together, because I've talked about taxes and probate and I've talked about capital gains. I've talked about legal structures. Let's tie it all together in just the last couple minutes that we have. We're going to combine it all together. Legal structure, as basic as I can get. Let's say I have a lot of activity. So I set up an operating company, whatever that is. Maybe it's managing investments. I set up this as a corporation or an LLC and take every tax advantage deduction that I can possibly take. I'm going to take rental properties. I'm going to hold those in a separate LLC. The idea is to shift as much liability up to the operating company away from the equity as I can. I'm going to move the rents, as much income as I can. I'm going to increase the rents so that when I receive it, that LLC will most likely be taxed as a partnership or as a disregarded entity. So all of those activities flow to me. It's passive by nature. I don't pay self-employment taxes. This is how Marriott is set up. This is how Hyatt, Hilton, this is how hospitals are set up. There's always two corporations. One owns, one manages. One's responsible for everything. The other has no liability, but that's where the equity, that's where the money is. And then everything gets tied down to a revocable living trust. All your rights and interests of the corporation go down to the trust. All your rights and interests to the holding companies go down to the trust. That is as simple as a diagram as I can make it. Here's how we're going to structure your business. If you have lots of rental properties, you might have multiple LLCs, but the trust, the corporation, stays the same. Well, if we're going to simplify your tax returns, this would require 5 tax returns, one for the corporation, one for you, one for each one of the multi-member LLCs. But sometimes we simplify this because single-member LLCs don't have to file tax returns. So I could have 97 different single-member LLCs all flowing into one tax return, which would be your multi-member LLC. That would be taxed as a partnership. That flows through to you, all the tax advantages. If 3 properties are losing money, 10 properties are making money, I want to offset those. I can do that in this legal structure. The corporation manages everything. Everything that I own flows through and avoids probate. Do you see what we're doing and how simplified that is? Sometimes I've if I sometimes I would keep safe assets, which means that don't things that don't cause accidents, brokerage accounts, syndications, things, um, cash, savings accounts, gold and silver, precious metals. Those things might be worth having a separate holding company to separate the safe assets from the real estate that causes liability. But again, everything flows down to my trust. Now, there's so much. 45 minutes doesn't give me a lot to time to talk about it. I did not talk about sophisticated LLC agreements. What if one partner has more money but really wants the tax write-offs? I want the income. Can we create that? Oh, I'd like to spend a lot more time with you on taxes, how to create anonymity in your legal structures, the best states to incorporate probate and estate taxes. I only spent 3 or 4 minutes. Sources of lawsuits. If you need to know who the enemy is, you need to understand where the lawsuits are going to come from. Tax-free planning. I'd like to spend a lot more time with you, but the best thing I can do is to invite you to attend our 3-day summit where we'll cover all this. 2 opportunities to attend this spring. One is in March. Again, it's in 3 weeks. It's a Monday. All of the art classes are Monday, Tuesday, Wednesday classes. I know that's a sacrifice. I know that's in the middle of a week. I guarantee it'll be well worth your time when you do that. And look at the agenda, and we'll send you that. It's posted early. There's sample ones. It's not a wussy little 3-day class. It is, in fact, if you're a professional, you would most likely always get continuing education credit. It's that good because of the firepower we're bringing in to teach.
Love it. Thank you, Don.
Okay, that's how you would sign up. How
Yeah,
did we?
perfect. Go there, and thank you for having a Sugo specific registration. That's awesome. And you guys will
Yeah,
see in the chat that we have a lot of our investors who have gone to this, and they're saying great things in the chat, that they love it. It's been great. There's a lot of great information. The summit is amazing. So there's some social proof from some people who have gone. And again, we hear great things. And it's a lot of information. It's live stream, which is nice. That's really, you can be, in your home and having in the comfort of your home, absorbing all this information. You can also have whoever you make these decisions with right next to you easily instead of having to travel. So I think that's awesome, Don. Don, will you be
sure thing.
around for the
Anytime.
Q&A later as well?
Absolutely, I'll be here.
Okay, cool. Because we have 13 questions in the Q&A, which we won't get to now because we're going to bring John on. But everyone, come back. Don's going to come back at the Q&A, so we will tackle all your questions then. Don, I appreciate it. That was awesome. My team and I, we were messaging each other on Slack. We're like, oh, we should do this, we should do that. So thank you for the information. It's good for everyone.
Thank you. We'll see you in an hour.
Okay, sounds good. All right, you guys, next up, we have John Hyre. John spoke on, an event we had, I don't know, maybe like 2 years ago. John, you want to come on screen? And he was outstanding. And so we've been coordinating him ever since to come back. He's super fun, super dynamic. Our head of investor relations said this. We should have put this in our email, maybe when we send it out, Cynthia. But she said, if I had to give, like, who in my life has changed my financial situation the most, like who's had the biggest impact on the financial side of my life, she said John Hyre. John Hyre. So that's, kudos to John. What he has to say is very powerful, very impactful. And, like everyone else, there's a ton of information to share. He's only going to hit the tip of the iceberg. He has so much education that he puts out. And as you can see, everyone we've had on this event is education forward. They want to share education with you. John has events and all his own. So I encourage you, you're going to hear a little bit from John today, but there's so much more. So follow him, get on his list. So much great information is out there from John to change your life. So John, thank you for being here. Super appreciate you being here on a Friday. I saw some talk in the chat about drinking bourbon. You guys will see what's on the wall behind John. It's not fake wallpaper. It's a real collection back there. That's what I asked him first time we got on camera. I was like, is that real behind you? So anyway, I'll say thanks for being here, John. It's an engaged audience, and I know you're great at engaging even more. So take it away, John.
Cool. Glad to be here. What time do you want me to go till? I've got my time is 4 o'clock here in Puerto Rico. How far do you want me to go?
45 minutes would be great if that works for you.
Sure thing. Oh, that'll give us time for some Q&A. Oh, wonderful. Okay, cool. So we'll take it away. We're going to talk about a couple of things. I'm going to add CPA in front of the CTA because I was talking to Cynthia a little before, and something that she had heard when she came to see me speak in Atlanta, she said, people really need to hear that. So we're pretty flexible. We'll improvise, go with the flow, see what people want to hear, see what's useful. The CTA is the Corporate Transparency Act. I dislike talking about it because it's negative in the sense of it's all bad news. And I like trying to help save people from things. But unfortunately, you have to know about it. You have to comply with it. And there really aren't many ways around it. So it's bad news. And that's why I put it up front. We're going to get into some self-directed IRA tricks. And I love self-directed IRAs, and 401k is probably one of my favorite tax savings devices. If it's good enough for Peter Thiel to turn $2,000 put into a Roth IRA into $5 billion tax-free, then I think it's good enough for us. I will also point out that it upsets the correct people. You'll have to Google to see who it upsets. I'll give you a hint. It's not the libertarians. And we'll also get into some passive activity loss movement. So a pretty basic intermediate discussion. I'll throw a few advanced concepts your way. Let's talk about what this is not briefly. Being a lawyer, it's mandatory, I tell you. This is not legal advice. I'm presently $1,000 an hour. How do you know you're getting legal advice? You're paying me $1,000 an hour. I'm looking at your personal situation. I'm giving you advice for which I'm liable. This is not it. It is education. Anything I say, if you try it at home without competent tax advisors, may result in a financial Darwin Award, deservedly so. Also, we put the caveat here, large audience, I don't know to whom I'm speaking. People, I am not woke, and I don't cater to that. So if you ever used the term "I'm offended" with a sane adult and expected them to care, I'm not your guy. I'm dead serious. You want to do something else, pause, come back tomorrow. You don't want to listen to me because you're being warned. I will offend you. I will trigger you. And it won't be a microaggression. That seems so inefficient. I'm going to go straight to macro and just sweep it all like a shotgun. Just let's get it all. You want to be a victim? I'm going to help you. So understand that, guys. I'm not going to cater to that stuff. And so this is this is not a joke now. If you're that disposition and you're easily triggered or offended, don't come back and complain to everyone. John was mean to me. Just don't listen. So Corporate Transparency Act is a disaster. Now, I have a fair number of slides for it. I'm not going to go through them all in great detail because we'd never get through the presentation. Rather, I wanted to give you more slides so that you have a little time to look at them and review them. Let me give you the, oh wait, I lied because I'm a lawyer and normally I only lie when I'm on the clock, but for you people, look, it's free. I said I'd talk about CPAs first, and CPA, CTA, all very confusing, especially on a Friday in Puerto Rico before I had my drink. I want to talk briefly at the request of Cynthia, a good request, about the CPA industry, about the tax advisor industry and the state of it, something you should understand. The tax advisor industry in general, and I'm just going to use the term CPA, although it can include enrolled agents, it can include tax attorneys. The industry is shrinking in absolute terms, and in particular on the compliance side. That is the people who do your tax returns, whether they're CPAs, EAs, other. They are shrinking in terms of absolute numbers. Wall Street Journal has run article after article. I live it and I see it because oftentimes I do the planning, I do the research. As you're going to see, an absolute geek. I love to research anything. I'm the guy who will pull up actual case law, not a summary, read the case, get the footnotes that cite other cases, read those cases and look for the footnotes and go to the cases beyond that. I really do like to geek out on this and find the best way to legally keep what is yours away from the feds, who are just going to misspend it regardless of who's running the government. And so it's relevant because the CPA industry is dying, both literally and figuratively. New grads, there are fewer accounting graduates, and a lot of them, instead of going into tax, are going into data analysis. It pays more. It has hours that the younger generation find to be more congenial, to put it politely. Older accountants are downsizing, a lot like MDs, actually. I see this with my MD clients, that they're tired of the bureaucracy, the nonsense. They've decided, a lot of them, they can work part-time, they can do it without employees or with fewer employees and be quite happy. And I'm seeing the very same thing with tax advisors and CPAs. Why do I mention this to you? Love and hug your CPA. Yes, they may not be perfect. The compliance part, that's doing the tax returns, has gotten much more difficult. The law has become more complex. The IRS, ever since COVID, has become more difficult to deal with, especially at the lower levels. The newer IRS employees, I know I'm being recorded, but I'm going to say it anyway. I just don't have a very high opinion of the most recent batch. Low paid, impossible to fire, aware of both. You do the math. So it's gotten a lot harder for CPAs. They have less time to research. They're working more hours. They're having a harder time finding employable people. And you should bear that in mind before you boot yours to the curb, or when you find a really good one and you decide you want to negotiate with them, because that's what real estate investors love to do, which, by the way, in my case, usually results in me hanging up on them. I'm not motivated. I'm not in divorce because I'm married to a Chilena, so divorce doesn't work. I just die. I'm not in foreclosure. I didn't lose my job. I'm not motivated, so I'm not looking to negotiate real estate investors. When you do that to people too much, they avoid you. But be nice to the CPAs. They're stressed. Their jobs have gotten a lot harder. They have less time to plan. What I'm seeing is an increasing number of CPAs, and again, the terms used generically, who will do the return, they'll look in the rearview mirror, but they just lack the bandwidth to do the research. They probably want to, but the bandwidth just isn't there. So be aware of that. Tax planners are becoming fewer and further between. Ditto CPAs. Now, back to our regularly scheduled programming, the Corporate Transparency Act. Not a positive thing. Unfortunately, you do need to know about it. Without going through the slides just yet, again, I want those so that you can refer to them. There's more detail in there than I'll be able to cover in the time we've got. Here are the basics. If you have an entity that to exist filed with a state or local government, some states are county, most of them have a centralized Secretary of State or corporate commission, et cetera, et cetera. If you filed anywhere to create the entity, so LLCs, LPs, corporations, you have 2024 to report it. Assuming the entity was formed before January 1st of 2024, you have to file information about the entity, the people who control the entity, and the people who own 25% or more directly or indirectly. If you fail to do so, or if you give improper information, or if you are late, the penalty is $500 a day per count. Per count. And I assure you, you're going to get, I mean, this is somewhat political, but it's also unfortunately true. They're going to count your counts the way they do for Trump, not the way they did for Hunter. In other words, every piece of wrong information, every report you didn't file is going to be a separate count, which means a $500 per day penalty up to 10 grand per count. Also, you can become a felon with up to 2 years in prison per count. So unless you are in a politically favored class and well-connected, I think the way they count for you will not be good. Now, let's not mistake, I don't agree with this. I think this is terrible in terms of politics, in terms of ideology, freedom. This is awful. It's really disappointing that our country would allow something like this to pass. But we have, and very few people are aware of it. It is about control. So what's my message to you on the Corporate Transparency Act? I think you should comply. I don't like it, but I think you should comply, not because I agree with it, but because the penalties are horrendous and you don't want to be the test case. I'll add a few details. Anyone who helps set up an entity, that would include explicitly paralegals, not just lawyers, but the paralegal as well. If they don't report your information, or at least check a little box that says, hey, the client was uncooperative. Now, what do you think happens when a lawyer or paralegal sets up an entity for you, an LLC, a corporation, an LP, whatever? and you refuse to give them the information that the government wants, a picture of your passport or driver's license and some of the information that's on that, what happens if the lawyer or the paralegal who does not want to go to jail on your behalf, because they're liable if they don't narc you out, right? Sounding a little East German. They're liable for criminal penalties, for the financial penalties, unless they check the little box that says, oh, my client was not willing to give the information. Now, what do you think happens once that box gets checked? Hello, red flag, right? Bureaucrats looking for something to do, and you have suddenly become their project. At what? $500 a day per count, up to 10 grand, up to 2 years in prison. So now I'll walk through it. Oh, one last thing. Again, I like to do first the verdict, then the trial. My kids hate watching movies with me. We watch Saving Private Ryan. They enjoy it. It's one of the few movies that I always cry like a baby. They think it's somewhat amusing until they see the movie and understand why. And they always know I'm going to say the same thing in the beginning. Spoiler, Germans lose. So spoiler alert here. What are, John, I expect you to be creative and tell us how to get around it. Well, I expect me to be creative. And if there's a way around it, to find it. I haven't found it. Had they asked the better version of ChatGPT, because Microsoft, et cetera, have their own more advanced versions of that. They asked Microsoft's private GPT, ChatGPT, what would Nevada, Utah privacy attorneys, what would the Delaware people, what would Jack Miller and other asset protection gurus do to get around the Corporate Transparency Act? Please draft a statute that puts them in their place. And boy, did they. When you see, and I put in these slides so you believe it, because a lot of you are, no, John, there's always a way around it. You're not creative enough. I need you to be more creative and thoughtful. Look, I quoted the law in here. They wrote it very, very, very broadly, and they made the penalties very, very, very nasty. Why did they do this, by the way? It's control. The first reason, and laws always metastasize. I mean, remember when back in 1913, I mean, you might not remember personally, but if you read your history, when they first did the income tax, they said, well, it would only apply to the top 1%. It's just this little income tax we're going to hit the rich with. That sort of metastasized. For those of you who follow law, RICO, the Racketeering, Influence, Corruption, et cetera, Act was only supposed to apply to the mob, to the mafia. Well, that's metastasized. Now, do you think this might metastasize? I think it will. I think it will. Now, here's the reasoning. Well, it's just so hard for the government to investigate layers of entities. And so instead of investigating layers, we want to know who the human beings, not the paper, the carbon-based life forms behind each entity are, because that just makes our job easier. And by the way, it's about the terrorists. And because of the terrorists, we need to know everything about every business. Everything about every business. So let's get into this. Which entities must report? And pardon me if you can hear the background siren. It's Puerto Rico. The concept of putting noise and pollution in the same sentence truly doesn't exist here. It's a great place, wonderful people, but noise, oh yeah, welcome to Puerto Rico. So domestic reporting companies, any corporation, LLC, or similar entity created by filing a document with Secretary of State or similar office. So trusts are mostly exempt. What's the problem with most trusts? They don't provide an asset protection shield in the way of an LLC or a corporation or an LP. So you have a choice to make. You can get around the CTA by eliminating all your entities. Now, you're probably going to lose some tax benefits. You are certainly going to lose some asset protection benefits. That's a tough trade-off. Most people are going to decide to comply with this and keep the asset protection and tax benefits of entities. There are a few, especially my hardcore libertarian clients, who would rather, fight the man, and they're going to switch to everything is in trusts. They're not going to have much, if any, asset protection. They're going to suffer some tax detriments. It's a choice. It's a choice. So sole proprietorships, general partnerships, trusts, mostly excluded unless a filing is required. And watch out for that. Some states do require a filing. Arizona, for example, is a little funny that way in terms of what it requires for filing. They're fairly comprehensive in terms of what they ask for. Foreign companies, once they register to do business with a similar entity, corporate commission, secretary of state, et cetera, once they register in the US, they are required to disclose the information. So who is a beneficial owner? Because that's what this is about. They want to know who is the human being, the carbon-based life form behind everything. And there are two ways they measure it. You must report all. There's always going to be at least one beneficial owner. And that's specifically whoever has substantial control. Now, as you're going to see, there might be more than one person with substantial control, given how broadly they wrote the statute. I'll give you an example. Entities I own 100% of. Obviously, I have substantial control when you look at the tests. And intuitively, if you own 100%, you probably have got control. You're the board of directors, assuming there's a separate manager. They have substantial control. You can fire them. You have substantial control. Let me add one, though. I think given how broadly it's written, my wife probably has substantial control. She certainly does over me, but also when it comes to work. In other words, I ask if she shows up in the office and tells someone what to do. I mean, that would require me to have employees, which I don't. I'm really not very good that way. You can probably see why in terms of certain personality and mental and emotional issues. But were there people in my office, maybe contractors, and my wife showed up to boss them around and they listened to her, which they probably would, does she have substantial control? Based on the very broad way it's written here, I think she does. You really need to think these things through. FinCEN always expects there to be at least one beneficial owner. Somebody has control. It's going to be, and I'm going to blow through these slides because I want to get some more fun stuff. I don't really like this part. 4 indications of substantial control: serve as a senior officer of the reporting company. Note, it is not based on your title alone. It is based on what you actually do. And that's why I worry that my wife might be a senior officer. She acts like one. People listen to her as if she were one. I mean, why even use the subjunctive? She might as well be one. They listen to her. It's the test is in, the proof is in the pudding. Has authority over the appointment or removal of any senior officer or a majority of the board of directors or similar body. She's got that. I mean, she can remove me from the planet. So certainly I can be removed from the company. But I certainly, as the owner, and to the extent we have officers and boards of directors, I have these powers. By the way, this is not and, this is all or. If you pass any of these tests, congratulations, you have substantial control. Check out the third bullet point, unindented. Directs, determines, or has substantial influence over reporting decisions. Boy, I think that brings my wife in. Look how broad that is. Think about how broad that is. How are you going to avoid that? Directs, determines, or has substantial influence over important decisions. Now sit down a minute and think about who has that kind of power. And remember, if you're wrong, you're a felon. I understand that some of you think I'm paranoid, but if you watch the trajectory of law and how these sorts of laws, when the camel gets his nose in the tent, the rest of the camel shall soon follow, you're going to see this expanded. You're going to see this to create felons. It's so easy to do. So many people won't know about it or won't comply perfectly. Last bullet point, or has any other form of substantial control over the reporting company. That's pretty broad. That's their catch-all. That's their catch-all. And remember, if you're wrong from this massively broad catch-all, you get to pay $500 a day for each count. You get to be a felon. That's insanity, but it is also now reality. Sorry. Who is a beneficial owner? Again, I'm going to skip through here. It gets into, take a look at that last bullet point. Who has substantial control? Because it gets into trusts and trustees, because they know you guys like to use trusts, trustees, nominees, etc., to avoid these sorts of things. Take a look at that last bullet point. Any other contract, arrangement, understanding, relationship, or otherwise that gives you the direct or indirect substantial control. That's as broad as it gets. That is so they name some things they know you people like to do, you people, those of you who want privacy, God forbid, that you would normally do to preserve privacy. And here they're saying, well, here's some specific things we know about. We know you use entities and straw men and appointees and all that sort of thing, nominees, trusts. So they name them just, because they're like, hey, we know about this. But look at that last sentence. That's as broad as it gets. Fail to comply, you're a felon. So sorry. The other way to be a beneficial owner is to own directly or indirectly 25% or more. And it's measured very broadly. Let me give you some forms of indirect ownership: owning through a trust, owning through an entity, owning through a nominee, owning it in your dog's name, having convertible debt, having options that could convert. That makes, if I have options that could convert to 25% ownership, or let's say the options could convert to 10% ownership and I have 15% stock, congratulations, 25% has been reached. Take a look. It should seem familiar, horrifyingly familiar, at the last bullet point. In order to get to 25%, they look at warrants, options, purchase rights to sell, etc. And then what? Any other instrument, contract, arrangement, understanding, relationship, or mechanism used to establish ownership. It could even be verbal. You could have a verbal agreement that somebody else will be the owner, and they swear to God, pinky promise, never to tell anybody. But what do you think happens when the nasty men in the black suits come in? Yeah, they're going to squawk and squeal and talk, and they're going to reveal the true arrangement. So any other arrangement, including oral, I don't, again, guys, I don't like this, but they wrote it so broadly. The coverage is shotgun, and the punishment, I don't even know what the analogy is, 50 caliber BMG for people who are into that. It's not good. More of who is a beneficial owner. By the way, if you have 25% votes or value, let's say I own 25% of the vote, but I don't have any of the value. I don't get distributions of cash, for example. And that would be a weird arrangement. But here's what this says: vote or value. If you have 25% of the vote or 25% of the value, you are a beneficial owner. They're being very, very broad here. Very, very broad. Here are some exemptions. I'll let you look at them. If you're a minor child acting as a nominee, custodian, etc., an individual acting solely as an employee of a company, sole interest is a future interest through right of inheritance, or creditors, but not with convertible debt. If it's a creditor, but the debt is convertible and it could equal up to 25% ownership, then that's going to be a problem. I'm going to speed up. I want to hit some fun stuff. A company applicant, the individual who directly files the document that forms a U.S. entity or first registers a foreign entity to do business in the United States. Oftentimes a service out of somewhere like Nevada, sometimes an attorney, sometimes a paralegal. Whoever files the document with the state to create or register the entity is liable. They are supposed to narc you out. This goes against hundreds, maybe thousands of years of English, British, superior legal tradition, that the attorney and the client have a special relationship. Not only am I not required to narc you out through protections like privileged communication, I'm not allowed to discuss your case with anybody. This turns it on its head for this. It turns me into your narc, and it makes the penalties so ugly that nobody is going to lay down their license, much less their freedom, much less $500 a day for you. So again, not a pretty thing what's been done here. So far, what information must be reported, although they're already expanding on the reporting information. They said the ink's barely dry on this thing. They told us what needs to be reported, and they're already expanding what needs to be reported. So, and that's what government does. Oh, this will just be used for a little teeny thing, it's just the terrorists. Okay, yeah, sure, So the companies must submit information on the company and the beneficial owners. Here's the company information that has to be included. Pretty normal stuff that's not hard to find anyway. They just want it in one easy to access place. Here's where we get to what has to be reported about beneficial owners. If you have substantial control or you have enough ownership, full legal name, date of birth, current address, not P.O. box. Ooh, P.O. box, UPS box. Hello, felony. Sorry. A unique identifying number from a non-expired passport, etc. Why did I put non-expired in highlights? Because you're going to see in a minute that if your passport expires and you don't update the information within 30 days of its expiring, hello, $500 a day, you get to be a felon. Oh, sorry about those 30 days. Yes, it's real. It's in there. It's insane, but it's there. So looks like people need to be a little bit more involved in government. This is what happens when we let the legislators go nuts. And they also have to have a document proving all this. So they want an image of the passport, the driver's license, etc. Bottom line is they don't want to go through a chain to figure out who ultimately owns it. They want to get to the bottom of who owns it. And like any properly crafted machination, let's call it that and be polite, there's a kernel of truth to it. Will this help combat terrorism, money laundering, etc.? Sure. But is that the real purpose? I don't think so. It applies to everybody. It applies to everybody. They're after all small businesses. But wait, the government says they're going to keep the information safe. There will be no leaks. There will be no hacking. But if you look at the statute, it allows even foreign governments. Again, it's in the statute. Even foreign governments can access this. Judges can access it. And I don't think they've done a very good job of defining when can a judge get this information. For example, maybe in a divorce, maybe you're being sued by a creditor. I don't think they've narrowed very well what a judge, or for that matter, a foreign government can do. They just basically are saying, trust us. We know what we're doing. And Lord knows, based on how the government's functioned for the last at least 12 years, 15, 20, 30, 60, I don't know. I'm really confident in that they're going to do a great job with this. They're going to keep your data safe. When do you need to report? If the entity was formed before 2024, you have till the end of 24. Miss it by 2 minutes, report in 25, procrastinate, welcome to felony land. By the way, watch out. There are some sophisticated phishing with a PH scams out there. I've seen some of them where they send you a document and tell you to fill out. It's for this. That's all phishing. It's all a scam. Don't do it. You can go online. And by the way, right now, the online system, predictably, the one that you have to use to avoid being a felon, is not really very good right now. If you're going to file online, there are two ways to do it. You can file online, type it in. I would not do that because you have no proof that you filed. They don't give you anything. There's no receipt, nothing. I mean, at least if you're doing it, film yourself doing it or something. There is a PDF you can fill out and then upload. And I would literally film myself doing that. By the way, you have to do it for every entity. I get asked the question, do series LLCs, does each cell in the series have to do it? Yeah. I have a master holding company and I have one property per LLC. I have 40 properties. The master holding company owns 40 single member LLCs. And which, by the way, I think is a terrible idea to have that many LLCs anyway, because you'll never maintain them and most judges won't respect them. I think that's abusive. It's too much of a split up, unless the 40 properties are, each a commercial building with at least $1 million in equity. One LLC per property is madness, but especially now, you have to file one of these for each and every entity. Not fun. Now, here's where it gets interesting. You have, for new companies in 2024, it was 30 days. They're now giving you 90 days because so many people are unaware of this. That was a recent legislative change. Companies that used to be exempt, which probably won't include you. I skipped that page. It's way back there. It shouldn't apply to most of you. I hear a lot of people saying, for example, checkbook LLCs, IRA-owned, 401k-owned entities are exempt. No, they're not. They are not exempt. If a company was exempt, then it becomes non-exempt. You have 30 days to update. If you don't, you're a felon. You're paying $500 a day. Not that they would ever do this to people in order to, nail the right people. Here's the ugly part, 30 calendar days for any updates. This is where I was getting at your driver's license expires, your passport expires. You have 30 days to update it. Your address changes, 30 days to update it. A new person has substantial control, 30 days to update it. Ownership changes, 30 days to update it. You fail, 500 a day, up to 10K per violation. Oh, so my passport expired and my address changed. Is that 2 violations? I don't know. I guess it depends on how much the prosecutor likes you and how politically well connected you are. Okay, I will take questions at the end. And sorry for that. I didn't want to talk about it. I don't like it, but you need to be aware of it. A lot of people either don't know about the CTA or they are in denial, or they think there's going to be a change, which isn't going to happen with the present constitution of the government, the way the government's set up now. And frankly, let's say the Republicans who were the most opposed to this get into power. Let's say they just somehow manage. They don't screw it up, which would be sort of a small miracle. They get into power. Do you think they're going to change this now that an agency exists and it's enforcing it and it gives them more control? Because control, one side likes it a lot more than the other, but it is bipartisan. I don't think it's going to change, unfortunately. I don't like it. So sorry to be such a downer. Let's get into some fun stuff. Let's see what time it is. I'm trying to track it so I leave time. All right, this is super important. I thought about you guys in particular because I know there are a lot of you investing in syndications, and I use the term loosely, whether it's a PPM or a private placement or whatever you want to call it. I'm going to use the term syndications. This next 2 or 3 slides makes the whole presentation worthwhile. Now, those of you who follow me already know this, and so you're going, I know where he's going with this. It's a glorious thing. Let's talk about this. When you invest in a syndication through your traditional account, whether it's a traditional IRA or a traditional 401k, normally when you convert to a Roth, let's walk through the example. And I'm just making the numbers up. So engineers, take a Quaalude, everyone under 35, Google what that means. But engineers, calm down. It's just a math number we're using for example. It's not a real number. It's all good. Calm, calm. You contribute $100,000 to your traditional 401k. You take a $100,000 deduction. Normally, when you convert to Roth, let's assume that you convert right away. You didn't have any income because the longer you take to convert, the more income that accumulates, the larger the conversion number becomes. For example, if the 100 becomes 110, now I have to convert 110 instead of 100. So converting sooner, all other things being equal, and sometimes they're not, but all other things being equal, converting sooner is better. So when you convert to Roth, what happens? Well, you add 100,000 back to income. In other words, it's a wash. It's a wash, which for me, that's just sadness. And so we've already had too much sadness on this call. Let us have some happiness. That will be the next slide. Let me explain how discounting works with estate planning, because it works the same way with income taxes. And that is a wonderful thing. A home is worth 200 grand. You put it in an LLC. You own half the LLC. Your interest in the LLC is not worth half the value of the home, $100,000. Specifically, there are 2 discounts. There are actually about a dozen discounts. I'm discussing the 2 big main common ones. There are a bunch more, but time. Pink Floyd song, Time, hurts every time I listen to it a lot. If you're not in control of the LLC, and in syndications, you never are, right? The management, there's nothing more immortal except a government program than the manager of a syndication. Typically, to get rid of them, they have to do something horrible on film twice and have a super majority vote that includes their vote to vote themselves out. It's very difficult typically to get rid of the manager or general partner of a syndication. So tax law says if you are not in control, there's a manager in control, there's a big discount for that. Let's just say 20 to 30% discount. Likewise, if your investment is not liquid, private investments by definition are not terribly liquid. You'd have to find an accredited investor who actually wants it. Most of them are going to look for a discount and a rather sizable discount. Sometimes the discount's larger because certain agreements will have poison pills in them. For example, right of first refusal in the agreement. And the operating agreement means what? Any seller or any buyer has to say, gee, I'm going to make an offer knowing that someone else can take it. Why would I do that? Another poison pill. Everybody has to agree. You put things like that in operating agreements, and transfers of control of ownership become less and less likely. The discount for lack of liquidity, meaning I can't liquidate my interest, become larger and larger. But in general, let's say the discounts vary from 20 to 30%. So again, in a syndication, do we typically have lack of control? Oh yeah. Do we typically have lack of liquidity, a lockup period where the interest is not saleable or only saleable at a discount? Oh yeah. So we typically end up with a discount of 40 to 60%. That number is going to matter in a minute. Take a look at the last bullet point. If you're going to do this, if you're going to convert a traditional to a Roth at a discount, I strongly suggest a light appraisal, essentially the equivalent of a BPO. I know people who will do this. If you email, we'll put you in touch with them. There are not very many of them, right? A lot of appraisers are capable of doing this, but they don't understand it. When you say, I need you to do an appraisal for purposes of converting a traditional IRA to a Roth IRA, but let's say I put 100 into the traditional, but I only want to add 50,000 to income. I want a 50% discount. I want all 100 of the traditional to become Roth, but I only want to increase my income by 50,000, not the 100,000 that we have here under the second bullet point. I only want to pay 50. I want a discount. To get an appraiser who will do that last bullet point is hard to do, not because the appraisers are incapable, but because they don't understand. And minds that are confused say what? No. The typical cost is $1,500 and it's generally well worth it. Think about that. I'm converting, let's say I invest 100,000 from a traditional in a syndication. And let's just split the baby. The discounts typically run 40 to 60%. Let's say we get a 50% discount. So instead of reporting 100,000 of income when I convert, because I put the money into a syndication, I only report a $50,000 conversion value. So what's it worth to you to show 50,000 less in income on your tax return? Well, I don't know, multiply it by your bracket, right? If you're in a 40% bracket, that's a 20 grand savings. Are you going to pay 1,500 to save 20 grand all day long, all day long? And here's our example. Contribute 100,000 to the traditional, take the deduction, 100,000. Invest as soon as possible in a syndication or private investment. Now, it has to make business sense. All things business and economics come before taxes, right? The tax tail never wags the business dog. That's a very bad idea. So it has to be a good syndication. Don't do it just for this. That's silly. You immediately convert to Roth, but you only add 40,000 of income if you got a 60% discount, or 60,000 of income if you got a 40% discount, or somewhere in between. Have I seen smaller discounts? Yes, on some funds that are very liquid. I've seen some funds where you can get cash very quickly. You can get cashed out very quickly. The discount is smaller. That makes sense. I've also seen some funds where there are other reasons for larger discounts. I've seen discounts of up to 80%. So there are other factors that could come into play. But bottom line is this. Take a look at that last bullet point. All 100,000 that you stuck in the syndication is Roth. But instead of paying 100 grand to convert, you're paying 40 to 60 grand. This is extremely powerful. I put this here because I know a lot of you invest in syndications. And whether you're a W-2 employee or you have your own business or a little bit of both, this applies to you. And what is shocking to me is how few people do this. How many of you have invested in a syndication with a traditional account and you could have converted and you didn't? And by the way, the longer you're in the syndication, what happens? The more liquid it becomes. The more liquid it becomes. And what happens as it becomes more liquid and you get closer to having control? Your discount gets smaller. When's the best time to convert? Typically right after you invested or right after the window for a closed-ended fund where that window actually closes. That's usually the 2 points where it makes sense to take this discount. Moving jobs. So let's say you have a W-2 job. You're in between jobs. Stop. Do not roll your 401k or whatever other retirement plan you have at work. Do not roll it to your new job unless you really like the 401k plan at the new job. Just stop. Set up a micro business. I want you to sell $2,000 net profit. I want you to generate 2 grand of net profit per year on eBay. And it's just one example. I want a micro business. I want this business to be so small, you don't bother to set up an LLC. It's not worth it. You just set up a separate bank account. And what do? You sell on eBay or whatever other, I'm probably outdated. There's probably something newer and better. I'm just, technology is not my thing. I'm archaic. I get it. You have a tiny micro business. It can generate more, but I want to see 2 grand net profit. Why? Because it can sponsor a solo 401k. What do I want you to do? Roll the 401k from your old job into the solo. Do not roll it into the 401k at the new job. That way, you can have this self-directed. You can invest in alternative assets. You can invest in syndications. So think about that. Now, I am a little bit conservative in that I like to see you continue that small business. Some people say you only have to have the business make a little bit of money that first year. These 401ks, especially if they're Roth 401ks, have massive, massive, massive net present value. This is one of the premier tax savings methodologies. Why endanger it? Sell your stuff on eBay every year. Make your 2 grand every year. Make a small contribution to the solo K every year. Keep it truly alive and moving. That's a little bit belt and suspenders. It's a little bit conservative, but we're protecting something very special and wonderful. And that is, in the case of a Roth, tax-free, which is much better than tax-deferred, but even tax-deferred beats taxable today. Now, take a look at that last bullet point. You're not moving jobs. Here's a clever little trick. Qualified domestic relations orders. Some of you are now on the floor sucking your thumb, twitching in the fetal position because you know what these are. They're usually really bad. When there's a divorce or a separation, it's a court order saying one spouse has to move X amount of their retirement account to the ex-spouse. And it's a court order. and the plan documents don't matter. If you get a quadro that says your 401k, 75% goes to your ex, done. That's what happens. Well, there's a silver lining. Most people are used to hearing of a quadro, qualified domestic relations order, in only two contexts, divorce or separation. There's a third, marital reorganization. What if you're, let's say at Microsoft or some other company that for whatever reason, you just don't like their 401k. You want to get into the alternative investment world. Maybe your spouse can have a tiny business, or maybe your spouse already has an awesome non-tiny business and they have a solo K or a self-directed IRA. They have the ability to self-direct. Well, you can use a qualified domestic relations order in about 35 out of 50 states to order movement of your work retirement plan to your spouse's self-directed plan. Now, usually you want to offset. Maybe some rental property goes from your joint names into your name. And my suggestion would be you only do this if you're really comfortable with the relationship, right? There's a lot of trust here. So if you're having a few doubts, you're kind of wondering, I don't know, then maybe that's not for you. There's a lot of trust required, but it's a nice little workaround. It's a way to access money from your regular job and get it into alternative investments. In about 5 minutes, I'm going to go through UBIT. Your retirement accounts are not taxable, except for when they are. There's this thing called UBIT, unrelated business income tax. If we had time, we'd go into the history of why it's called that. And three things trigger it. You need to be aware of this. Three things: renting out personal property. So you rent out furniture, cars, or meth labs. That causes tax. And it's a high tax, 37%. And you throw in taxes like California, it can be up to 50%. UBIT's very high. The second thing that can trigger UBIT, continuous trader business, basically a business that sells inventory or provides services. And finally, borrowing. Borrowing creates UBIT, but only on the portion borrowed. So let's say my IRA or 401k goes and buys Bitcoin, and it borrows to do it. It puts down 20 grand to buy Bitcoin. It borrows 80 grand, 100 grand total. If I sell the Bitcoin and make a profit, 80% of the profit is taxable. That's a simplification. Anything the syndication does, your IRA or 401k did. It's the opposite of the Las Vegas rule. What happens in the pass-through entity does not stay in the pass-through entity. It's attributed to your IRA. So if you invest in a syndication that borrows or runs a trader business that involves inventory or maybe building developments and selling them, or involves borrowing or involves providing services, that's all attributed to your IRA, and UBIT is a possibility. You need to do some planning. Now, we don't have time to get into it, but some common concepts are using a C corporation as a blocker. So if it's a situation where you're making a ton of money, you're like, listen, John, I'll pay tax. I'd rather pay 21% corporate rate on a 40% return than 0 on a 4% return, which, by the way, is a completely rational thing to do. What do? You use what's called a blocker. You have a C Corp created, owned by your IRA or 401k when it's investing in something you know will be 100% UBIT taxable. What does it do? It drops you from the UBIT rate, 37%, to the corporate rate, 21%. That could save some people money. 401ks are subject to the UBIT rules. I hear this all the time. 401ks don't have to pay UBIT. Wrong, wrong, wrong. If anyone says that to you, just in your mind, shoot them, but only in your mind, right? This is not the voice telling you to do violent things. It's just inappropriate mental suggestions. 401ks are subject only from one type of UBIT. When there's borrowing to acquire or improve real estate, if that's the only thing causing UBIT, unlike an IRA, the 401k is exempt. And that does describe some syndications. So if you have a syndication that's going to borrow to build and rent, for example, then you want to do that in a 401k instead of an IRA. Quick passive loss primer, and I have to go very quickly given our time. Passive activity losses, as many of you know, are bad. If you have losses from a passive activity, you're not involved in it, or any rentals, those losses hibernate on your return, which is not what I want. I want them awake and functioning. I don't want them to be somnolescent or senile like never mind, I won't say it. But anyway, I don't like passive losses hibernating on my return. I want to make them active. Since we only have a minute, I'm going to skip this slide. I was going to get in the real estate professional status, but I want to give you one little trick I like quite a lot. When you have a piece of real estate, you can decide if for passive loss purposes, it's a rental or if it's a hotel. Now, Let's say you work a full-time job. You don't have time or ability to qualify as a real estate professional. Qualifying as a real estate professional makes your rental losses non-passive, which is really good. It means they offset your W-2, your business income, et cetera. But qualifying is really hard. It's easier to qualify under the normal passive activity loss rules. Well, if you have a property and you rent it out on average during the year, it's rented out on average for 7 days or less. For passive loss purposes, it is not a rental, it's a hotel. Why is that good? Why is that good? Because in order for those losses to be active, good losses, not sleepy losses, awake losses that offset all your income, all you have to do is participate in the property. And by the way, if you have a spouse and your returns are married filing jointly, both your times count. So you can add your time together. If you participate in a hotel, AKA Airbnb, if you participate 100 hours or more and no other human being puts in more time than you during the year, those losses are active. And that's really important in that first year. When you do your cost segregation study, you get all that extra depreciation. That's the big loss year. In fact, it's very frequent for clients to say, well, for the first year, we're going to rent this out short term. We're going to qualify for material participation. Those are the tax words that allow the income to wake up on your return, no longer hibernate, no longer be passive, to be active and go out there and offset your W-2 and offset your business income. That first year, they say, we're going to work over 100 hours and we're going to track it because the IRS won't believe anything you don't track at the time you do it contemporaneously. And I'm going to track the time every human being works to prove no human being worked more time than we did together. Spouse and you count as one. No other human being works more than you. You work more than 100 hours. The losses wake up. They're useful on your return. What happens in year two? Whatever you want. If the property is better run as an Airbnb, run it as an Airbnb. Well, you don't want to do it anymore because you only did it the first year to get this wonderful tax status. Great, get a management company. Oh, I decided to like midterm rentals better. This whole traveling nurses thing is very lucrative. And by the way, it is. I'm going to do that instead. That's fine after first year. You got the big losses the first year. Subsequent years, heck, that thing might even show income. You would have a passive income generator that would suck up passive losses from other activities. And I am 2 minutes over my time. Hopefully it was worth it. Sorry I had to rush on some stuff. I always try to put more on the slides that I can cover intentionally. I know a lot of it was horrific because that Corporate Transparency Act is just a nightmare, but it had to be discussed. So I couldn't be as happy. I normally like to discuss things such as the discounting. I'm going to save so many of you money, and that's just one tiny little trick. Where are other places to learn? Very briefly, I'll do a free 1-hour Q&A for this group. So take a look, March 29th, 7 p.m. Eastern Standard Time, 1 hour, free Q&A. Send your questions in. All things being equal, and they're never equal, I will answer the first questions that come in first. And that's, by the way, something we do on my webinars. I do webinars twice a month. The first webinar is a topic of my choice. This month, we're doing PPLI, private placement life insurance. The second webinar is always raw Q&A. It's a good way to have access to me. So this will be an example of the Q&A. And we normally do the webinars, the monthly ones are each 2 hours. Sometimes they go over. So you guys have a chance to ask more questions than you're able to ask today, March 29th, 7 p.m. If you're interested, we'll send out an email. Just reply to the email and we'll send you the Zoom link. Also in Puerto Rico, April 20th and 21st, a Saturday and Sunday, we are doing a deep, deep, deep dive on self-directed IRAs, self-directed 401ks, health savings accounts, Coverdale educational savings accounts, a real winner in the business world, rollover business startups. These tax saving devices, I gave you one little trick that's going to save a lot of you a ton of money. Come get dozens more. Puerto Rico, in person only, 20th and 21st. We've got the monthly webinar. Last, maybe least, is just the first slide, how to contact me. How to contact me. And so hopefully I've been respectful of time here and we can go to Q&A. I don't want to keep Dawn or others waiting.
Oh, this is perfect. This is awesome. Love it. I was just checking my calendar to see if I'm free. I'm going to be in the Caribbean sailing, so maybe I'll sail by.
Just wave. Just wave.
Hi, everybody learning about
Hey, if
Sam?
you're stopping in St.
Um,
Martin, you can buy really good bourbon there at great prices. Ask me how I
great.
know.
I believe it. I believe it. All right, you guys all have a screen capture. You have how to contact John. Also, for everyone on here, all the speakers will have your email address. So they will reach out and contact you. So part of signing up for this is awesome. You can reach out to everyone and everyone can reach out to you. So don't be afraid you're going to miss out on any good information from any of the speakers. We'll switch over to Q&A. Audience, if you use down at the bottom of the screen, it says Q&A. I see a whole bunch of stuff in chat, and I think that was just chat. So if you have an actual question, use the Q&A function, and we will run through that right now. And John and Don, since we have a ton, if you guys want to see stuff and just like pick it, and then if you guys aren't saying anything, I'll pick one, and we can just run through as fast as possible.
All right, I'll start to look there. I'm technically incompetent. Don, if you just want to tag team, you do one, I do one.
Great, great. How do you wipe out taxes on moving a chunk of money from a 401k to a Roth IRA? John, you're better equipped to do that, but sometimes you don't. You're going to pay the taxes, but think of it as you don't always have to do it all at once. You can do it slowly over time. I'm going to do $50,000 this year and 50,000 the next year, but sometimes you wipe it out through a real estate loss. I still pay the taxes, but now I've got a loss, and so I can offset it. John, how else do you offset some of that
They must have
tax?
asked it before I mentioned the discounts, because if you, and
Yes.
again, you only invest in a syndication if it makes sense for you. I have clients, for example, who will use their 401k to do, for example, flipping, and that has various implications, but they won't invest in a syndication. Now, should they go invest in a syndication in order to get the discount? No, that's not their business model. First the business, then the tax. But if you can invest in a syndication, that's one way to do it. And then I think what Don was saying is pretty much the normal things that create losses. All the normal things that create losses will offset the income from converting a traditional to a Roth. And as he said, take your time, space it out if you can. That's where, as he said on his talk, details do matter. So our questions or the answers are necessarily generic.
Since we're on that topic, I see a question. What's the best way to minimize taxes on syndication capital gains?
Do it ahead of time. Again, I get so many calls. I just sold something. How do I not pay tax on it?
Too
Oh
late.
yeah, you should have
Yes.
talked to me sooner.
Yeah.
Oh,
Yeah.
Bart,
Yeah.
oh. So again, I'm very partial to these IRAs and 401ks. Oh, but John, I can only put 7,000 a year into my IRA. Oh, you can put so much more into it. You can put so much more into these pension plans. There are so many ways, and they can borrow and they can partner. There are a lot of creative ways to get more money into them. So that's my first answer. Second, it depends, right? I give you a lot of great tax planning advice, and some of it is horrible, horrible life advice. And that's where we have to have a conversation and square it. For example, my wife being a real estate professional would result in my death. So I would save a lot of taxes and the kids would get a quick step up in basis. But in terms of lifestyle, no, no, no. So some thoughts: you could have a charitable remainder trust own the interest that you're going to sell. If it's a non-depreciable thing, you can have a trust that the kids are beneficiaries of, but you got to do it ahead of time. For a trust that the kids are the beneficiaries of, and specifically an irrevocable trust. These are a little bougie, a little expensive. It's got to own it for 2 years. You got to plan ahead. So if you've got, for example, a business, you know you're going to sell it. You want the kids to get it. You want to do some estate planning. You want to do some income tax planning. One thought is you create a trust. The kids are the beneficiaries. The trust sells the business on an installment contract to the trust and then sits on it for 2 years before it sells. Why? Because let's say your basis is 100 and the installment sales $1 million. You get a step up inside the trust to $1 million after 2 years when you're selling to related persons. So there are a lot of them involve charity, charitable remainder trust. Now, what's the problem with a charitable remainder trust? It's not a pure tax play. You have to have charitable intent. If you're trying to do it just for tax purposes, you're probably going to be really sad with the results. Those are a few that I could think of, but they all require you do something ahead of time. The only one you could do after the fact is an opportunity zone fund, and that's just a deferral. They're nice. The internal growth is not taxed if you play it right, but the growth that you use to fund it is merely deferred. I could go on, but people would probably start protesting, rightly so.
I think the key is do it before you sell the property, but before you sell the investment. Afterwards, we are so limited. But before, there's lots of options. Um, just before you sell the property, and John, I'm like you. I've had hundreds of calls. Okay, I just sold this property. How do I avoid the capital gains? Well, you called me last week, and then I can help you. Yeah. All right.
Yeah, awesome. Thanks for that. All right, next question. Can a lawsuit against a property in one IRA bleed into other IRAs? Like, if I'm at risk over here, if I'm doing something risky over here, can someone get at my other IRA if I have multiple?
Well, I love the question because you're saying let's separate this IRA from that IRA, and if it's run separately, then the idea is no. You're a beneficial owner. That's why we sometimes don't put, just like we wouldn't put 10 or 50 properties in an LLC, you probably wouldn't put 50 properties in one IRA. You'd have more than one IRA. You'd separate them. I'm like John. If I've got 50 properties, I don't need 50 LLCs. Look at your net worth. Look at what you're willing to amount of risk in any one. But I love the question. But in theory, if it's run right, you've got a custodian that's running, and no, that's why we do it. So one liability won't leak to the other. John, your thoughts?
Yeah, let me add a little extra gloss on it because we've had the situation. I think in general, that's the correct answer. We get a little more specific. Which state are you in? Let me give you an example. You're in California. California provides almost no protection to non-ERISA plans. So ERISA is a federal law. If it's your IRA is never covered by ERISA. If you have a qualified plan like a 401k, it may be, and you really do want it to be if possible. Why? Federal retirement plan asset protection is on a bad day equal to your state, and on a good day way better. California being the prime example. What California basically says is we only protect retirement accounts to the extent that you need them to live, and our standard for you to live is under a bridge and taking into account all of the other income that you do or could make. And so it'll vary some. I think Dawn's generally right that it's very difficult generally in most places to break into an IRA. And remember, one of the reasons, and I don't know if, Dawn, you covered this in your presentation. I came a touch late, but I'm getting the recording. So a checkbook LLC, you have to be careful with them, but they are useful. If there's a trip and fall in a property directly owned by your LLC, you can be held personally responsible. The IRA is just a trust. It's a grantor trust, essentially. It doesn't provide asset protection. One reason to have an LLC owned by the IRA is asset protection. Now, given some fairly recent case law, the McNulty case, you have to be very careful how you set up and run those LLCs, especially if they're owned by IRAs. It's another advantage of 401ks. So like most questions, complex, I think the general answer is correct. It's hard to break into IRAs, but if you live in an unfortunate place like California, then there are some challenges.
Yeah, and I taught recently a whole webinar on IRA protection and all the state laws, and there were 8 states that would protect that would not protect it, an inherited IRA, and there's some states that have limits. And Minnesota, I think their protection taps out at like $68,000 is all they'll protect, and so I taught that, but it's on our YouTube channel, protectwealth.com. Google it, and it's available, or I don't know, send me a link. But generally, IRAs are fairly well protected. But you're right, they're not ERISA protected. Okay.
And I am looking forward to looking at that link because there are so many unreliable links to state law on the internet where when I follow the link to the statute and read it,
yep,
I won't name the custodian because I'm nice, but they have links that are no good. So I can't wait to see that. That's good information you have out there.
Good. All right. Can you claim real estate losses?
Oh, go ahead.
So if you can you claim real estate losses if you aren't a real estate professional? The answer is yes, but it only goes to offset investment income. unless you're a real estate professional. Is that anything to add to that, John?
I'd say that's about right. I mean, if you're a real estate professional, your rental losses offset everything. There are exceptions because there always are, and we
Yep.
don't have time to discuss them.
All right, I'm going to take this one because I get this one personally a lot from investors. So it's about UBIT. So if I invest in a real estate syndication with my IRA and incur UBIT on exit, but I put the IRA money into another real estate investment in the same year with bonus depreciation, does the bonus depreciation offset the capital gains to avoid the UBIT? You know, similar to if it's outside of the IRA, and adjust
That's a
it.
com that's a complex and nuanced question. There are two ways to avoid, off the top of my head, to avoid the UBIT in a situation. I'm going to assume it was, I think she said it was real estate. Let's assume it was rental real estate.
Apartment buildings, let's say, a syndication.
This is really important. When you file the UBIT return, the 990T, there are silos, and the silos cannot touch for losses. So when you file the return, you want the fewest possible silos. For example, let's say I get into 4 residential rental projects. A lot of accountants will naturally report that in 4 columns. And if one of them has a loss, it doesn't apply to one of the other columns. The loss just hangs out there and does you no good. So if it has the same standard industrial classification code, SIC number, you can put it in the same column, and you really, really want to do that. So if I have a loss and then in the same year I get into something that I have a gain and I get into something in the same year that generates a loss, if they're in the same silo, it's going to work. Another thought, if you're able to 1031, now if you own the real estate directly or it's a tenant in common interest, you can 1031. If it's in a syndication, then you can't 1031 typically. Most syndications are not geared to do that.
No.
But if 1031 is a possibility because of direct ownership, anything that will offset normal income tax works to offset UBIT. And
Okay.
finally,
Awesome.
this is really important. I've seen a lot of accountants miss this one. When you have a long-term capital gain asset, and the only reason it's incurring UBIT is because there was debt on it, which is typically the case with rentals, the capital gain rate is reduced, just like it is for humans. It is not the 37% UBIT rate. I've seen accountants report at 37% over and over. The rate is closer to 20%. There's a complicated calculation, but if you end up paying tax on that kind of UBIT that would have otherwise qualified as long-term capital gain and is only UBIT because of the debt, at least you're paying at a lower rate. I can't tell you back when I had a return practice, thankfully I don't anymore, how many returns we amended to fix that error.
So, and I'm kind of going through and I'm picking things that are of the same theme. So it's still on UBIT. So to avoid UBIT, or you can, capital gains on this can be negated by some losses over here if they're in the same column, even if it's in your IRA. And then another solution would be Rob's, right? Or no, sorry,
Okay.
the Blocker LLC.
All right, so the blocker is only used when the UBIT is caused by a trade or business. I buy a Dairy Queen, I buy a law firm,
So it can't
directly
be
or indirectly.
for real estate.
Usually the math for a C corporation to negate UBIT that is already being taxed at 20% due to capital gains. In other words, remember, let's narrow it to 2 types of UBIT. Trade or business, we're selling a bunch of stuff or services.
Yep.
That we want a blocker for because that's 37% UBIT, 21% corporate.
Okay. Okay, so Stacy, let me know if that answered it. All right, I'll let you guys grab some now. The rest seem to be kind of all over.
Don, I've been hogging. I don't want to hog. Go for it.
No, that's fine. How do you pay for your kids? And can you pay for your grandchildren? Yes, anybody who's contributing to the corporation, you can pay. You remember, anybody you pay over $600, 600 or more, you have to issue a 1099 or a W-2, and so you treat them normally. You still have to report it. It's just that they don't owe federal taxes. And then my understanding is if you're paying them out of a sole proprietorship, they're also not subject to self-employment taxes. And so be careful. Just if you're paying them out of a C corp, they might not pay taxes, but you might incur self-employment taxes. But be aware of that, and sometimes talk to your tax professional and find out how to pay them. Remember, what you're paying them has to be ordinary and customary for what it is they're doing. You can't pay a 3-year-old for, doing your accounting services. But modeling, absolutely, we could do.
I'll actually differ on that. I think if an IRS agent, this is not directed at anyone obviously in particular. In the modern world, you have to say this, but your kid's ugly, right? This whole thing about you're paying the kid 12 grand to be a model, and it just happens to be whatever their standard deduction
Right,
is.
right.
That you got, like he just said, it has to be justified by what's market rate. Who else is paying your kid to model? Now, I did have one client whose kids actually made more than that at an actual modeling agency. So I'm like, all right,
Oh,
fair.
cool. Just remember, when it comes to taxes, pigs get fed, hogs get slaughtered. Just be reasonable in whatever you're doing. Yep. Okay. I haven't been paying attention anymore. Why don't you take the next one? I'll
What you
read
got,
up.
Sarah?
All
I am
right.
trained. I'm trained to listen to women.
Okay. Okay. So there's a question about, all right. So one of our funds is a Forex trading fund. And so, whoever's asking this, you're signed in as anonymous. So I can't, get back to you later, but know that we are having a webinar with the CPA for that investment. So you can really dig in, because these guys don't know the total background. But in general, if you're going into a fund with your Roth IRA and the fund is trading, so it's not real estate, it's commodities, it's something that's trading all day long. It's not like buy and hold kind of a fund. And what kind of taxes would they experience in the Roth IRA? Does that make sense? Or should I restate?
Yeah, I'd actually have to research it because I have to see what they're doing. So here's the thing. It's kind of like dealer status with even less case law. Once you hit a certain volume inside of an IRA and you are quote unquote a continuing trader business, there's usually UBIT. But securities, I think the threshold would be extremely high, very high volume before they would even think about doing it. I'd have to actually look that one up. Arguably, you could argue there's no UBIT. I'd have to, again, research and see, but you could argue there's no UBIT. But because if you're doing enough volume, it's gray enough. Because remember, whatever happened in the fund happened in your IRAs. They're doing massive volume to where it's clearly a trader business. And you're going to take the position of, I don't think this is UBIT taxable because it's securities trading. And again, the numbers are different, right? If you sell 3 houses in your IRA per year for 5 years in a row, you are paying UBIT, no question. But volume matters. The case law and the history is different with securities. The IRS is much, much, much more permissive of high volume securities before they even attempt to argue, hey, you're going to have something like UBIT or whatnot. So if you're going to argue that it's not subject to UBIT, I would file a 990T, that's the UBIT tax form, with zeros on it to get the statute of limitations, which is generally 6 years rolling. And that's only when you have a gray argument. You don't use that in the black and white situation. I could see this one being gray. Let me give the caveat of securities are taxed in very specific ways. And I haven't dealt with that in a long time. That was a prior life where I dealt with mixed securities like Forex.
Awesome. Do you have anything to add to that, Don?
No, I think
Okay.
I'm going to jump into Abby's question about
Go for it.
properties in Florida, and it depends. If it's your personal residence, Florida has a great homestead protection. There's 11 exemptions that I've found, but don't tick off the federal government, and pay your spousal and pay your and pay your property taxes, and but generally, if it's your personal residence, apply for homestead. It's great. For rental properties, land trusts, we love land trusts. In most states, it's a really good smokescreen. We'll use it maybe to avoid a due on sale clause. We use it we'll use it for anonymity, but we don't use it for asset protection, except Florida. Florida has great laws, and sort of non-technical language. What they're doing is they're saying personal property can't be taken in a lawsuit, and if I've got a rental property, put it into a land trust or convey it to the land trust. It converts it from real to personal property, Land trusts are great in Florida, but in most cases, we would put properties in LLCs. In Florida, there might be an exception where we would use land trusts rather than, they're cheaper. There's no annual filing fees. If we're doing it right, we might hold rental properties in land trusts, and then we would generally put those inside of a holding company, let's say a Wyoming LLC, or we use something that's really strong. But I like land trusts on a limited basis in most other states. John, what's been your experience?
You know more about Florida than I do in terms of specifics. Overall, I view land trusts as a smokescreen. They do have a cost. You have to run them right. You got to go to someone who knows what they're doing, teaches you how to run them. If you're willing to take the time, which is a cost, and educate your vendors, the insurance companies, et cetera, because they're not going to know what to do with it. They're going to say no, because that's what a confused mind says. So that's the price. What does it get you? Some anonymity. And I have had, here's a true story. I'm almost never a trustee because there's liability. But I had a Japanese client, a friend. I like him a lot. I was a trustee for his land trust. I get a call from a clearly disgruntled activist weirdo I demand to know who the owner of this is. No. What? No. Well, you have to tell me. No, I don't. And what land trusts are good for is getting rid of the idiots and the lazy. And given that we are living idiocracy, it has increasing utility. But some people don't understand how to get around them. Now, don't count on it with a serious, sharp lawyer that has a real case. If there's a real case, something really happened, a serious trip and fall, and especially if you've ever met anybody, such as the tenants, the land trust isn't going to do much for you, and that's not its purpose. Some people have this idea that, for example, it hides me and I can't be served and they can't find me, and that's not how it works. They just go and say, we're going to get a judgment like we do on a foreclosure. We're going to publicize for judgment. We're going to get a default judgment. They're really good for dissuading lazy, and unfortunately, a lot of lawyers are, and unintelligent. And once again, I have to plead guilty for at least part of my profession on that. Of X number of cases just go away.
Yeah.
Land trusts are it's a wonderful tool to have in your tool belt but I see it used too often. You own a property in Kansas, you've owned it for 27 years. Everybody in town knows you own the property, and it disappears into a land trust. Oh my gosh, people aren't stupid. Or you use a quit claim deed. You own a property, you quit claim it in. You would never buy a property with a quit claim deed. You would transfer it in only if you knew you would use a warranty deed. And so there are things that I told you 90% of the people I've seen do their own land trust, screw it up. But it's true that Disney bought big part of Orlando using land trust. Nobody knew it, but he used it correctly. Use land trust only with professionals, in my opinion. Okay.
Awesome. Well, with that, I'm going to say thank you so much to Dawn and John. Thanks for spending your Friday afternoon with us. This was awesome. There are 56 open questions, so we can't possibly get to them all. However, you guys know how to get in touch with both of the gentlemen on the screen. They've both offered additional education for you and additional ways to stay in touch. So we have a speaker page we send out to everyone, and there's a green button next to each of their names on the web page, and it says how to get in touch, how to continue learning from them, how to communicate with them directly. So all of these questions, the 56 questions, if you really need that question answered, link up individually. Say, let them know your full situation so they can give actual actionable advice for your individual situation. And, tons of folks, we've had both of these. Or be part of your group as well, John. People can ask Q&A there. And, continuing to learn and apply to your individual situation. And I will say we've had both of these gentlemen on events before, and our clients at Sugo, when they go talk to the organizations, absorb the education, the additional information that's out there from John and Dawn, they come back and tell us so many great things like, oh, okay, I moved my this, I did that. And so I love that you both were here sharing all your knowledge. It's so beneficial for investors, and especially folks like the Sugo Capital investors. So I really, really appreciate it. Audience, the replay's coming out. You can watch this today again and again. If you need time to absorb it, you can share it with anyone, rewatch it with folks you make your financial investing, asset protection, and tax decisions with, so that you can move forward and take action. And this is the last day of the series, of the Confident Investor series. So I appreciate everyone who is on here. We had hundreds of people on for 3 days, and that is awesome. You guys are the ones who are going to be able to take action, especially right now in Q1. We still have so much time to change our financial trajectory for 2024. And you have plenty of resources now to help you do that. So I look forward. You guys are going to all hear from me next week. Additional information is coming specifically from Sugo Capital. And then you'll probably hear from these gentlemen in the coming weeks as well. So again, John and Dawn, thank you so much. Super appreciate it. And I am looking forward to next time, and have a wonderful weekend.
Thank you. Thanks, Sarah.
You're welcome.